Hello guys, and welcome into this video. In this video, I'm going to show you this booming crash index strategy that I have been using to catch spikes easily, right? So this is a strategy that consists of only one indicator, which means we are only going to be putting this one indicator. And if you look down here, you can see that we're actually having the MACD indicator, and this is an important indicator which is an oscillator, but it also helps us to reveal points in the market where the momentum is in support of the direction that we want to trade and where the momentum is not in support of the direction that we are not going to be trading. So this will help us a lot to find the potential points or the potential areas that we can actually enter the market when trading boom and crash. And remember guys, we're only going to be trading spikes, and we're going to be trading using this strategy on 1 minute time frame. So what are we going to be looking for in this particular strategy? So it's important guys that you master these important patterns when trading booming crashing, is because you're going to be seeing these patterns again and again and again and again and again and again. So the first pattern that we're going to be looking for is a simple pattern, and if you have been watching my previous videos, I think now you're now familiar with these patterns. The reason why I repeat them, because these are the patterns guys that can actually change the way you actually trade, because it's easier for you to catch these kind of trades than trying to actually try to catch a reversal trade right here in these kind of areas. Why? Because the market sometimes can actually continue to push the price down in this trend, which are the trend of these small candlesticks in manipulation, right? So to avoid manipulation, I've come out, or I've identified through backtesting and actually looking at the markets for a long period of time, I've seen that these kind of patterns that I'm going to show you right now are easier and are less riskier if you are going to be catching spikes. So taking for example guys, look at this right here. Let's say we have a market that is actually pushing upwards, and we can understand that if we have a market that is going upwards, this kind of market, it moves in two phases, right? The first phase that we are going to see, it's a phase whereby the market is in an impulsive movement. It's whereby the market makes a push, but later on it enters into what we call a correction phase. A correction phase, it is a phase where the market is just consolidating in a certain area or in a certain point, 2 points where it is actually failing to break either above or below. So in this kind of market, this is the kind of market that you want to ignore, and you want just to wait for the market to do what it has to do until the momentum comes back again, right? So this strategy, why do I call this strategy a little bit more better than trying to catch these kind of reversals and try to catch spikes in a market that is pushing down, is why? Because when the market now, it has been consolidating like this, but decides later on to break upwards out of this structure. And remember, we're talking about spikes. Like take for example here, we're having boom 500 index. So let's say we have already have a market that is already pushing upwards. We have seen that it is going upwards, but now later on it enters into a correction phase. The moment the pressure or the momentum comes back again, this is the point whereby you're going to see again the spikes now coming out of this structure. So for a long time, the price has been squeezed. For a long period of time, the price has been failing to either break above or to break below. But now when the momentum comes back in, it will force the price out of the range, out of the consolidating phase, which means the spikes, you're not going to see the spikes spiking out of the channel or spiking out of the flag, and you're going to see the price now continuing now to actually do something like this, going upwards. And these are the kind of movement that we want to catch guys, and it's simple and it's more or less riskier than trying to catch this kind of movement that you can catch below right here, right? So this is what I'm going to be teaching you guys, in how you can actually grow an account to a very big size using these lesser risky types of trades when trading spikes. So you can use it on any time frame, but in today's video we're going just to focus on 1 minute time frame. So I'm just going to show you as well how we combine it with the MACD oscillator and why it's important, the MACD, that you included as well in your strategy. Okay guys, so what you're going to be doing is that After you've identified the market direction and see where the market is going now, what you want to do is that you go on 1 minute time frame. This is going to be a lazy day. You don't want to do all the hard work, so you're just going to shift to 1 minute time frame and try to catch 1 or 2 trades that are going to give you some money for the day, and you call it a day. So what you're going to do is that you're going to identify the market direction, and for that, since you're going to be trading on 1 minute time frame, you want to check for your trend just on 50-minute time frame, just to have a different kind of view of what is going to be happening in the next 50 minutes or in the next 30 minutes or no, in terms of the market direction. So important, guys, that you do so, and there are so many ways that you can actually identify the market direction. The first thing that I recommend you is that you can do your market structure analysis, or you can use the 48 exponential moving average. It's so simple. You just put it in there and it shows you where you're going in terms of the market direction. So when you find the market direction, you can see that the overall direction of the market is going to be bullish, since we're going to be trading boom, and we're going to be looking to buy the market since we're going to be trading spikes. So we want to catch these spikes, guys. This is what we call spike. These long spikes upwards here is what is going to make us a lot of money in the market. We're going to stay away from these candlesticks and want only to be trading these spikes. So what we're going to do is so simple, guys, is that we're going to be looking for these kind of patterns that I've been showing you, right? So take for example, look at this. We have this pattern right here. This is the first pattern that I found here. I'm just going to change the color here and make it blue, and you can see how we have catched this descending channel. This is a descending channel. You can see how the price has been descending, right? And the most important thing when it comes to this descending channel, guys, let me just show you a tip very, very quickly, right? So we are having a price which has been doing like this. It must have 2 pushes, right? If we're going to be taking buys, right? The first push, which is a certain push like this, and the price is going to make another push to the upside, but it's going to continue to make a deeper pushes. So what I just want to show you is so important, guys. See how the price has made 2 pushes, right? Look at here. I'm just going to take this. This is the first push to the downside, and this is the second push. So if I'm going to be drawing my descending channel, you see I'm touching 2 points right here, and the next point, it is going to be the area where the price now is going to come and break out of the structure. So if I'm going to draw my descending channel or our continuation patterns, you can understand that I have 2 pushes. There must be strong 2 pushes. The first push down and the second push down, and the price will not come and break upwards right here. And this is the point now we're going to be looking for our entries, and this is where now we took our entries and we are anticipating to go upwards with the price. So it's also so simple, guys, and this is how you identify very strong continuation patterns, and continuation patterns that will work and the continuation patterns that will not work. So if you look, guys, at this kind of continuation pattern, you can see there are actually 2 strong pushes in this, because the first push is to make sort of like this structure point, which is a lower low here, and the second push, it must make another push that is going to give us another new lower low. Guys, look at this section. It's so important. If you miss it right here, you're going to miss it all over, and you're not going to be catching this kind of move. This is how you identify a strong continuation pattern. It must have 2 phases whereby the market is dropping like this, and then it pushes up again, and then the market drops again, and it must break this low to make another new low. This is the perfection of the 2 pushes of a continuation pattern, right? So after we identify this right now, what we're just waiting for, right, is for the market to break out of structure. So this is the point where we have the market breaking out of structure. You can see this, guys. You can see this spike. We're just waiting for a spike that will break out of structure. Not only that, now, this is where the magic happens. And this is the most important thing, right? If we look on our MACD right here, and if I just put it right here, I'm just going to change it and give it a different color. And I'm just going to choose white right here. And I'm just going to make it a little bit bold so that we can see the area that we're talking about. So we're just going to be looking at the exact point where we start to see these bars here crossing the 0 level here, and these bars here. And if you see on the main chart, this is going to be an area as well that we see the price pushing upwards and breaking out of structure here with a strong spike. So which means we're going to be entering here, and now we can take our trade, guys, and we're just taking our trade from this point, and we're just targeting the uprights right here. And you're catching how many spikes here? 1, 2, 3-4 big spikes, and this is about 70 to 80 pips, guys. And this is how it's so easy to trade spikes. And look how this is going to save you from trying to catch the spikes from a market that is pushing down like this. You don't know where it's going to reverse. You're just thinking, no, it's going to spike here, or it's going to spike here, or it's going to spike here, but the market will continue to. This is how Deriv has been manipulating traders, guys. So you need to wake up now. You need to wake up, guys, and start doing the right thing. And I'm showing you the best thing that has been working for me, and it can also work for you if you are willing to take this information and you go on your demo account and you start practicing and practice and practice and track until you perfect yourself, right? So when it comes to stop loss, someone might ask, where are we going to be putting our stop loss? Because it's very, very important that you master where we are going to be taking our profits. Where are we going to be putting our stop loss? So what I recommend you guys is that when it comes to your stop loss, right? Your stop loss is important that you put it on the last push that was made the price before it breaks upwards, right? This was the last low that you can see here. I'm just going to change this, and I'm just going to give it a pink color so that we can see it right here. You'll see on the charts right now. Right, so this is where I'll put it down here, guys. And for me, this move, this point, from this point here to the point that I'm going to be entering here, for me, if the trade goes against me, that's going to be meaning that maybe I may take a loss of 7 or 5 candlesticks. For me, it's good. And most of the time, the price will give me a no drawdown trade. So look here, the price, we entered here and we just have 2 candles and we are already in profit. So which means, guys, if you're trying to grow small accounts, trading boom and crash, this is the best way that I would recommend you. And when you're using this strategy, you want to stay away from boom 300 index or crash 300 index, since nowadays it requires a lot of margin to actually trade those pairs. And if you have a small account, you're going to have it so much difficult. So you want to focus on boom 500 index, on crash 500 index, and you're going to see how you're going to be able to actually make a lot of money trading these kind of patterns. Like, let me just show you another example, guys, that we're having here. So this is another trade. So per day on 1 minute time frame, you have to actually write on your trading plan how many trades that you're going to be taking, because there are going to be a lot of opportunities, and some of the times you might catch some good trades, then you get into over trading. You don't want to do that, right? So if you can catch 1 or 2, 3 trades per day, then you get out of the market, you are good for the day, you can grow that small account to something else, then you get out of the market so quickly, and this is going to allow you not to overtrade, because on 1 minute here, you're going to see a lot of opportunities. And actually saying, guys, that this is just a boom 500. What about crash 500? What about boom 1000? What about crash 1000? So this, look at this other opportunity here. We have a nice descending channel right here, which is so perfect. And the most important thing is finding and looking and verifying and the strength of our continuation pattern. See how it made the first push right here, and it made the second push right here, which means this is a strong pattern right here, and you can see how it descended like this. So the first spike that we got, it was at this point right here. This is the point where we have the first spike that get out of structure, and this is the point that we could have entered the market. So which means we could have caught this trade here. Look how big these spikes just went it up. But before we enter, we need to confirm with the MACD where exactly we're going to enter the market, because the first bar of the MACD is the point that we're going to enter the market. So it's going to be a sniper entry, because you can see how it actually pointed this point right here. So which means we're going to be supposed to be entering somewhere around here. Let me show you guys. Somewhere around here. This is the point that could have entered, and we could have caught this move all the way up, guys, going upwards like this. So guys, you continue doing like this. You catch 1 or 2 trades on 1 minute time frame. If you are lazy to do it on 5 minute time frame or 15 minute time frame, then you call it a day. You get out of the market. You take that $40 account, you grow it to 100, 150, 200, 300, you get out of the market. Do not over trade. Remember, these are synthetic indices. You can find them each and every day, Monday to Sunday. There is no offer. Anything, you can still get a lot of opportunities each and every day. You need to set a disciplined trading plan, and you follow that. This is what will separate you from any other trader who just doesn't know what he's doing. He just wants to trade, right? So let me just show you one last example, guys, and you're going to see how it's so much powerful. So the reason why here, some of you might ask and say, why didn't we have any trade right here? Right? We didn't have any trade. Why? Because on the MACD here, we didn't have the price doing anything or crossing. So this is how you actually identify. So this phase here, if you see the MACD bars down here, it just means we're in a strong downtrend. So in order for us to actually enter buys, we want to see the MACD just above the zero line. This is what it means. The momentum in the direction of the bullish market will now get in when the bars goes above the zero line, So we're just gonna continue to come here, and we're just gonna do it like this. You can see how we actually drew something that is so nice right here. You can see we had a nice descending channel right here, and you can see how the price right here continued to move, but it didn't move, right? It didn't move so big, because this was the first push of the channel, and this was the second push, right? So we want to see the price breaking out of structure, but from here it didn't make any move that was big. Why? Because from here we are still waiting for the MACD bars to get upwards, right? Upwards. I think somewhere around here, this is the point that we have these MACD bars now above the zero line. So this means on the top right there, we're going to be entering somewhere around here and hoping to catch all this move going upwards. In our stop loss, we just make sure that we put down low here, and then we are good and we take our buy trade, guys. So you can do this over and over again. You're going to see a lot of opportunities, guys, each and every day. What you just want to make sure that you remain disciplined and you just follow the rules each and every day.